What happens when the smartest people in finance are wrong? In 1998, one hedge fund nearly broke the world. It was run by Nobel Prize winners and financial superstars. Their model said disaster was virtually impossible. Then the impossible happened. 4 months later, they had lost $4.6 billion. Let's rewind. John Meriwether was the best bond trader at Salomon Brothers, which made him, for a period in the 1980s, arguably the best bond trader in the world. He had a specific genius: finding tiny pricing discrepancies between similar bonds and betting on them. When two nearly identical securities were priced differently, Meriwether's bet was that eventually the prices would converge. They almost always did. When Meriwether left Salomon Brothers under a cloud of controversy in 1991, he took his core team with him and started a new fund. He called it Long-Term Capital Management. The name was chosen deliberately. This was not speculation. This was not casino behavior. This was the patient, disciplined application of mathematics to find and exploit the gaps the market left behind. The dream team he assembled was extraordinary. Robert Merton and Myron Scholes, two of the architects of the Black-Scholes-Merton model, the equation that underpins modern options pricing, joined as founding partners. In 1997, while LTCM was still running, Merton and Scholes received the Nobel Prize in Economics. Their partners threw a party. David Mullins, the former vice chairman of the Federal Reserve Board, joined. Every major bank wanted in: Merrill Lynch, Goldman Sachs, J.P. Morgan, Deutsche Bank. They all became investors and creditors. The fund's minimum investment was $10 million. LTCM returned 28% in its first year, then 59%, then 57%. The Nobel Prize winners were, apparently, correct. By early 1998, LTCM was managing $4.7 billion in equity. From the most prestigious investors in the world, nobody asked what would happen if the models were wrong. The returns were too good to question. The strategy was elegant and, in calm markets, genuinely brilliant. LTCM looked for what traders call relative value opportunities, places where two similar assets were priced differently when they should have been priced the same. The simplest example: on-the-run and off-the-run treasury bonds. An on-the-run bond is the most recently issued treasury. An off-the-run bond is slightly older. They are nearly identical in credit quality and cash flows. The only difference is the on-the-run bond is slightly more liquid. Because of this, investors pay a small premium for on-the-run bonds. LTCM's bet: this spread would eventually narrow. It almost always had. Statistically, this was a very safe bet. The problem was that the profit from such a tiny spread was also tiny. To generate significant returns, LTCM needed to bet enormous size. They borrowed aggressively against their positions. For every dollar of investor equity, they controlled approximately $25 to $30 in positions. By early 1998, LTCM had $4.7 billion in equity, but it had $125 billion in assets, borrowed money, and its total market exposure, including derivatives contracts, was approximately $1.25 trillion. Their models told them this was fine. The models were built on historical data going back decades. They showed that the positions LTCM held rarely all moved against them at the same time. The fund's risk was diversified. They were not concentrated in any single trade. What the models could not fully account for was correlation, the tendency of unrelated assets to start moving together during a crisis. In normal times, different markets are independent. In a panic, they are not. Everyone sells everything. Every spread widens. Every diversification assumption breaks down simultaneously. The models had not seen enough panics, but they had seen enough good years to feel certain. August 17, 1998. Russia defaults on its sovereign debt. The Russian government announces it cannot repay its obligations. A staggering event, the first major sovereign default by a nuclear power. Investors panicked. And in a panic, investors don't think about relative value. They sell everything that isn't a U.S. Treasury bond. They sell emerging market debt. They sell corporate bonds. They buy the most certain thing they can find. This is called a flight to quality. For LTCM, this was a catastrophe. Every single trade they had on was built on the assumption that spreads would converge. The flight to quality caused every spread they held to diverge instead. The on-the-run versus off-the-run Treasury spread, which should have narrowed, blew out to levels never seen before. Every position in every market moved against them at the same time. The models had assigned this scenario a probability that was effectively zero. It was not zero. In August 1998 alone, LTCM lost 44% of its equity, 44% in 1 month. The fund was in a death spiral. With 25-to-1 leverage, a 4% loss on assets wipes out equity entirely. LTCM was losing far more than 4%. Every day, the fund needed to post more collateral. Every day, positions were being liquidated at terrible prices. By mid-September 1998, long-term capital management had $600 million in equity left. Down from $4.7 billion, the losses were $4.6 billion in 4 months. But the immediate crisis was not LTCM's bankruptcy. The crisis was what would happen when LTCM was forced to dump $125 billion in positions onto markets that were already in panic. The fire sale would crater prices everywhere. The contagion would spread. On September 23, 1998, the Federal Reserve Bank of New York called an emergency meeting. The presidents of every major Wall Street firm were asked to gather. Alan Greenspan had determined that LTCM was too interconnected to fail. The Fed did not write a check. Instead, it convened a consortium of 14 major banks: Goldman Sachs, Merrill Lynch, J.P. Morgan, and 11 others. The banks contributed $3.625 billion in exchange for a 90% stake in the fund. LTCM's partners were wiped out. The fund continued operating under bank supervision, unwinding its positions over the following year. One firm refused to participate. Bear Stearns, which had been LTCM's prime broker for years, declined to contribute, a detail that would be remembered a decade later, when Bear Stearns itself required an emergency rescue. The lesson that Wall Street was supposed to take from LTCM: models are not reality. Leverage is dangerous. Correlation breaks down in a crisis. The lesson that Wall Street actually took: the government will step in when things get bad enough. Merriweather launched new hedge funds. The banks went back to using leverage. The models kept running. Merton and Scholes kept their Nobel Prizes. Roger Lowenstein wrote a book about LTCM called When Genius Failed. It became required reading in business schools. It did not prevent the 2008 financial crisis, which was built on exactly the same foundations: borrowed money, mathematical models assuming historical correlations would hold, and the quiet certainty that the people running the system were the smartest people in the room. They were. And that was the problem. If you enjoyed this story, subscribe for more finance disasters, market crashes, and billion-dollar mistakes that changed history. The next one is even crazier.